Hi, this is Randy Finney with the right side of the chart, and this is a mid to late, actually late session update for Monday, June 16th, 2025. It's 3:14 p.m. Eastern Time as I'm starting the video, so we've got about 45 minutes left in the trading day. Let's just do it this way. Let me just, we'll take a look at some of the recently highlighted trade ideas and go that way. We'll work our way down on this page right here. We'll work our way down to the indexes here. And I'll just go in order. And what I'm going to do is also hit on related items here. So I gave you sugar today. Sugar, of course, being a commodity, so I'll hit on the sister trades that we have there on the agricultural commodities, wheat, corn, and soybeans. So not much to add other than make sure you might have, if you're interested in the trade, you caught the long-term chart of sugar I posted down here. These are sugar futures. And again, this is a chart I've shared over the years, but not recently. It's been a while since I traded sugar. And it just trades very well to the technicals. You look for these divergent lows like that one. You get these rallies that you typically, not always, but typically end with divergent highs, new trend. And these are major trend changes. These are, you could see sugar priced in, down from, up here 36 cents down to 10 cents. So, cut in third. Or, if you go in reverse, go from 10 to 30, you're at a 300% return there. Or I should say 200% return. But either way, there's the long-term chart. And again, I gave that to you this morning. We're coming up on this support level here. This line goes all the way back here. You have support back here, major reaction high. I haven't touched or modified this line or any of these horizontal support and resistance lines in a while. That may have been the last time I shared sugar as a long trade idea. And that's DL1. That says there, divergent low 1 around the 17-ish support. And then this is DL2 coming up on the 16. So there's a little downside, and I gave you the, it meshes with the chart I gave you on Kane. Kane. SGG got retired. A lot of these agricultural ETFs got retired in the last several years from the issuers, but SGG we used to trade, and you can see that one SGG stopped trading. So back on June 9th, that's when they 86'd a whole lot of them. And this one's Kane, a couple left around, different company, and that's it. So it's like any trade, take it, leave it. But it's that divergent low. It reminds me a lot, and this is why I wanted to loop in the related other agricultural ETFs that we have, or ETNs, corn, wheat, and soybean, the three grains. They keep putting in these divergent lows and then, rallying off there, getting some nice swing trades. But when you look back at the bigger picture, you go to a weekly chart here, like so many of these commodities, they were in a bear market for quite a while and heading down, bottomed when COVID hit, just like the equity markets peaked, trough there. And then this is when the whole commodities new bull, which I maintain, is underway. And so I'm looking, long term, higher prices in commodities, including these agricultural commodities. So there's not much to add that I didn't already cover. I gave you a 60-minute chart as well as the futures. Oh, there it is. Well, other than the fact we broke out today. But let me cover the rest. That is wheat, corn, soybeans. Wheat, did just see a comment. Wheat looks like dead money. It's, again, I've commented it multiple times, many times for the past year. We're at long-term support. I don't have, no, I can cue it up for you. I have to try to remind myself to loop back to these charts. There's always new folks coming to the site and want to make sure they know the bigger picture. This is wheat. That's the year. Think of the dot-com bubble right there, 1999's early 2000. That's when the NASDAQ peaked. And then wheat began this super secular uptrend here. Beautiful uptrend line. We've had multiple trades off that trend line. I started highlighting it last year in 2024 when we hit it. And all we did is we just hit it again. It's still poised. It looks good. And again, if it takes that trend line out, different things are going on. If it clearly takes it out. Although anytime soon, just like I mentioned, if we dip below, have a little flush out move, you're going to have strong positive divergence. So again, I'm viewing this as a long-term trade. It just needs to take out that trend line and get going. And I think the potential's there. And then on that, that's what it looks like on the weekly chart for the ETF or ETN really. for you traders there. Typically the commodities, some have ETFs, most are ETNs. You can get the differences in the FAQ page on the right side of the chart under ETF related questions if you want to know the differences. Similar, but not exactly the same. All right, so, but it does overall they do a pretty good job of tracking. And again, if you don't trade futures, that's what they're tracking. They're tracking futures, using futures to track the price. And so if you don't have a futures contract, you don't have an option. If you want to trade them, these are what you trade, and otherwise do something else. But I'm a big fan, as you know, of diversification, and that includes asset allocation, mixing up different things. So again, we just, has these little 60-minute fits and starts. This is a 60-minute chart, divergent low. And a lot of times these 60-minute rallies have ended with divergent highs. And this is the most recent divergent low. We hit this, we took out that R1. We've just been consolidating here after the break of this wedge right here. And so just needs to really clear out. This is why I gave you R2 and R3, R1, 2, and 3. These are resistance levels that when given this last trade set up here to break of the trend line there, we need to take that out to open the door to my price targets. And then, as I've said, a solid break above T4 will most likely open the door to those longer term swing and trend targets that I've given you on that weekly chart of wheat right there we were just looking at. And now keep in mind, the other grains, although wheat, just continues to kind of inch down, it's going a hair low, technically speaking, it's a little lower than it was before, but hardly. It's just kind of, the rate of descent has almost stalled out. And then the other two, grains, there used to be a one-size-fits-all ETF called, JGG, I believe, or JJG, one of the two. And it had corn, wheat, and soybeans because those tend to move together, your three grains. That one also got retired. SGG, no, that's sugar. I just covered that. Whatever it was, it doesn't matter because it's gone now. But back to cane, back to corn. Let's look at corn. You remember corn has bottomed. Corn is highlighted back here. Give you a total of 6 targets. Actually, way back here. I started highlighting it last year at that divergent low. Made a marginal new and still divergent low after hitting our first price target right here. And it didn't exceed a reasonable stop based on the entry price relative to the final target. So it's still just one long-term trade. And unlike wheat, both corn and soybeans, which I'll get to in a second, that is the low so far. You've got some positive divergence setting up here. Again, we hit T1 once right here. That was it. And we hit it once again. And so obviously, if I thought it was resistance way back here, which I did, the fact that we've hit it twice, got rejected, further validates that as a significant resistance level. Hence, that's what needs to go. So it's some work to be done, including this downtrend line to be taken out. But if and when that goes, pop up to there, and then once that pops, I think you'll start to see the momentum begin to accelerate, and these targets get hit in relatively short order. What's relative? Relative to the term of the time frame. This is a long-term trade. Months would be the time frame measured in there for those targets to be hit, and all of those targets. All right, and then soybeans, SOYB, also peaked back last year, late 2024, with that divergent low. Went right up, hit my first target there, pulled back as expected, typical reaction. So far, putting in higher lows. And again, you just need to take out T1, as you always do, to open the door to T2. And likewise, take out T2, it increases the odds you go to T3, 4, 5, 6. So there's your update on the grains. Go back to the site. Alrighty, where were we? The Visa and American Express, since they're both the big credit card companies, we'll just hit on those. Somebody said the reason they went down, again, as I often say, the technicals and the fundamentals go hand in hand. Somebody stated it was some of the big retailers like I think Walmart and another one, maybe Amazon, talking about offering stable coins. Doesn't matter. It's news again. Fundamentals flow together. Hit T2, bounced. Typical reaction so far. Big old gap right there. You could lower stops to entry right now for a 0 loss break even on the trade. You could lower them down a little, somewhere halfway, I'd say, in that gap if you wanted to assure a slight profit. Either way, I still maintain these next targets. We just need to get that next leg down. It's a solid sell signal breakdown. divergent high, so they still look good. AXP as well, hit T1 right there. Close enough. I didn't mark it as a hit yet. I don't think I did get to hit that 200-day moving average as well. So if and when T1's taken out, you're going to take out the 200 simple moving average, which happened right here, and then you back test them, and then you had that. That was the previous targets I gave you last time from up here, and that's it. So those targets I still maintain. They're pretty deep and aggressive, and they mesh with my stock market targets. If the S&P is going to my longer term targets, most likely the credit card issuers are going to fall due to just less swipes going through, because we'll almost certainly, about a near certainty, be in a recession if my longer term, I'm talking my deep targets of a 50+% pullback in the NASDAQ and about a 45-50 in the S&P are going to be hit. So I don't think these are overly aggressive targets. And again, if you don't share that view, you can swing trade and hit the short-term targets and go long if that's your thing. If you think we're going to new highs, use these as levels to buy on pullbacks too, or set your stop somewhat below them if you're long this one. But nice looking chart, and so far playing out as expected, following the recent sell signal. Okay, next up, well, here we go. Let's just get to the SPY, ES, NQ, all the good stuff, the indexes. I'm just going to go in order here, these trades. So remember, big part of my analysis, I always analyze the charts on multiple time frames, and the longer term time frames paint the bigger picture. Short term, you get a little more noise, helps you get in and out. You get your shorter term sell signals, get in quicker, out quicker. But on using the long term charts on these trend indicators, you can see here, you know, the PPO is one of many that I use, and when the PPO signal line, that's the 9 EMA, crosses below the zero line, that signals a trend change. Back here, you had a sideways market with multiple near 20% drops. They were 20% in the NASDAQ and the small caps, 15 or so in the S&P. That was back in 2015. We had a 21% drop right there with the PPO crossing below zero line. 36% drop in the S&P when COVID hit. 28% bear market back in 2022. And then recently we crossed below, and we remain, again, the signal line. I use that often because that's the last of the two to cross, and therefore it minimizes whipsaws. And if we're on a weekly chart, all that really matters is how you close the week. Anyway, there's a PPO. Where did I put it? Histogram. Nope, wrong one. Put this back. Somewhere here I had the histogram. Keep putting the wrong one. I'm trying to see here. PPO histogram. Where did you go? Okay, there you are. That is on the weekly chart of SPY, and that one has crossed. The weekly is a little more whippy. Longest term I like to use is a monthly chart. Kind of, you can have a lot fewer whipsaws. This is a monthly chart of SPY. We're going all the way back to the last real bear market. There's been you know, in recent decades, I'm talking 30 plus years, there's been two real bear markets. In other words, they ran their course about as natural as they could to the end. That's when, you know, the government started flooding with quantitative easing, zero rates back in '08. But the 2000 to 2002 bear market, after the dot-com bubble burst, all that, those are the real ones. And you can see they were defined. It's typically, once you get the bearish cross, that comes earlier. Once it's over, bear markets end and usually have very strong move off the bottom. So, you know, you don't want to use that as much as your exit point. But again, it does define the trends and captured the bulk of the bear market there. So, and all I'm circling here for you is every single time, without exception, the PPO histogram crossed below the zero line right here. That's the zero line where it delineates red and green. So 22%, 15, 20, 27. That was 15, but I had a question mark, meaning more to come. And then this little drop here. This one's not over, so I don't have the percentage because the PPO is still solidly on a sell signal again. That's a weekly chart. You can look at QQQ, same thing. You can see the PPO histogram is clearly still on a sell signal, and nothing can change on this that matters until the end of this month. So we're about halfway through there, and so that helps formulate, you know, bigger picture where we're going to go. And just take it down to the short-term frame. Down Friday, up today. You can see here about a wash. So really, from a technical perspective, despite the nice pop today, nothing's changed technically. We broke all those trend lines, including the S&P 500. First, QQQ broke down, then the S&P 500, SPY, ES, and that's it. So we're kind of just, again, the indicators continue to diverge. I'm talking about the momentum indicators, the RSI, the PPO. Somebody asked, it's a good question on the site. Gosh, I have to go to the main. Here, I'll find it. Go home, back to the main board. This one here. Somebody asked about covering divergent highs and lows. There's not a lot to do in a video, and I will, if I get the time, I'll do something to that effect. But where is it? Let me see. Can you do a teaching video on how to draw and monitor divergent heights and lows? And I welcome these kind of questions. Here's a link right here. You can check it out on stockcharts.com. Great resource, and talks about the divergences right here. Technical indicators somewhere on down here. Was positive and negative divergences. You can read all about it, and it's pretty simple, guys. You're just looking to pick your favorite momentum indicators and oscillators. I like that. If you don't have the PPO, use the MACD. They're very close cousins. Some charting platforms don't. PPO and the RSI. You can see my settings on there. These are the default settings for the PPO, and typically RSI 14 you want to use, and that's it. So you want to just look for security making higher highs, and then your momentum indicators, when they stop making higher highs, in fact they start making lower lows, it shows momentum is waning. It's just simple. It's just not 100%, just like overbought, but that's what you want to couple those with. You want to couple the first, you tend to become really overbought and then less overbought, right? That's the whole nature. This is the RSI. And so that is the nature of a divergent high. You had an extreme overbought reading. You get some people coming in, and security keeps lifting up after a little bit of a correction off that first overbought reading. And then that's it. And usually then the momentum is waned, and then you get the next correction or entire trend change. It depends on the scope of the divergences. This is a 60-minute chart. This is my go-to swing trading time frame. So when I get divergent lows and highs here, that typically will indicate a trade that's going to last anywhere from days to weeks, usually on a 60-minute time frame. However, when the charts are what I call stacked, it's a term I've made up, when you can come out here to the 60-minute chart, out to the longer term daily time frames, you've got the negative divergence as well, as I've highlighted recently right here. Divergent high, there's your negative divergence indicators making lower highs. Prices are wedging up a higher high. There's the sell signal we just got on that 60-minute charts. And then all the way out to the weekly, you can see my divergences. Or if you can't, I'll draw them for you real quick. These are your divergences right here. Looking for my line tool. There we go. Steepening off there. That was a big fat divergent high with, as highlighted at the time that week, a bearish engulfing candle, which still has marked the top. Those are potential topping sticks, and only time will tell if this is the first leg down, a rally that's kind of just healthy, to say the least, but we're still below there. And as I said, sometimes you get these perfect little textbook topping sticks, like a bearish engulfing candle, or evening star doji, island top, island cluster top. There's many types of top and bottom candlestick reversal patterns. And then sometimes you will punch through them and still continue down. So all I can tell you is if we do make a marginal new high, which again, as I've been saying for weeks now, because momentum's been slowing, we're within spitting distance of new highs. Then if we do, you look for a back test of this uptrend line right here, because this was a trend line broken, 200s got broken, and back test of the trend line, you could get a rejection there. If it happens anytime soon, it is 100% guaranteed to be still another divergent high. Again, if it happens soon, because the indicators are lagging to the point that if we made a marginal new high this week or next, it would not take out or negate these divergences. And then I can go all the way to my beloved monthly time frame. You rarely get divergences on the monthly. Well, you do back in the 60s, 70s, when you had the last real bear markets, the secular, longer lasting ones. We've been in a secular bull market since the beginning of the 1980s when interest rates peaked and began a new secular bear market in interest rates. So this all kind of ties into long-term stuff here. There's TYX. This is as far back as the history on this chart goes. This is a mid-70s right here. But I can tell you that we had rising rates. We had, bear market and persistent inflation started really in the late 60s, went well into the mid 70s. Interest rates peaked right here. And then we began a secular drop in rates, which ended when the government hit, both the Federal Reserve and the federal government and governments around the world and every central bank around the world just hit the panic button, the nuclear button, shot us full of liquidity and fiscal and monetary stimulus. And then that ended that trend right there. So that's, how it plays out in the coming decade or so. I could see a back test or not. Anything much more than that, we start taking out these previous lows, then then maybe something else is going on. But by every metric I have, interest rate, the bear market in interest rates is over, and that should coincide with an end of the secular bull market in equities. Nothing lasts forever, not any trend of anything out there. So it's been a long one, and again, make no mistake about it, that's the fundamental catalyst for the super secular bull market in equities. And again, where does it end? Well, it's going to certainly be a shot across the bow to the stock market if and when TYX, the yield on the 30-year bond, which I was just showing, pops and breaks that multi-year, really even get up here at multi-decade highs. And again, it may or may not happen, but if it does, then I think you'll see a rapid exit for the rush for the exits in the stock market. All right, I think I covered it all there, but just to get back, if I didn't, I hit on the QQQ 60-minute chart. SPY is what it looks like on the daily. There's the recent breakdown, still below there, kind of, just grinding around sideways. There's the wedge I gave you, that trend line that had to go on SPY, which broke right there. Basically, back tested it today on this little after Friday's or Thursday's breakdown, Friday's follow through, back test today. Okay, REMX. This is a setup. If you're not familiar, the difference between a trade, active trade, and a setup. Setup is just like that. I don't have to explain the word setup. I think you know what a setup means. Something that is a thing requiring a certain catalyst or condition or trade. In the case of a trade, a breakout. And REMX is right there on the line, getting close. You have both the downtrend line and 430 price resistance. We're on 430 right now. What you want to see is an impulsive solid break and or daily close above. So this one looks ripe to break out, but we're right on, as I said, when I'm doing the video, we're on 430 right now. We need to pop that level and ideal in day close. And you have the 200-day moving averages, both the simple and exponential coming in above it. First target, first resistance. That's why I did R1, R2. Meaning first resistance, second resistance, T1, T2, T3, and all these potential targets if they play out. So I still like that setup. We just need to pop and run. All right, next up would be, I already covered that, AMX, because I looped in Visa first. SPY, QQQ, I just covered. Oh yeah, let's talk about the VIX. Mr. VIX, volatility index, where are you at? Right here, this was on May 30th, so just over a couple weeks ago. Had us all, these are long-term trade ideas. I've had the VIX laid out, almost all these divergent lows have been highlighted there. But this one, I had us either taken off here, depending on what happened with the stock market, or going down to this level right here. You can see the arrows drawn at 615. And then the other day we hit, 1615. Then we hit 1615. Now let's update the VIX. This is the spot VIX. I'll get to VIXY in a second. So that was a 60-minute chart. 1615. The low was, where is it? I don't know. Close enough. You can see it pretty much hit it there. Again, close enough. And pop above the trend line, and that's it. So it still looks good. There's your trend line right there. Breakout back test, moving higher, And if the market starts another leg down soon, this should take off. Remember, your proxy trade, you cannot buy the VIX. Nobody can directly. You can buy options on VIX. You can buy VIX futures, options on those futures, or any of the ETFs or ETNs like this one that I use that tracks those futures. And that's VIXY. It's kind of been the proxy. And we've just, it's a longer term trade with swing trades within. As you know, we've covered when T1 was hit, we were covering our index shorts. That's when I expected the rally to backtest the 200-day moving averages. So we were in here before the breakout off the lows, rallied up there, hit that, pulled back. I give you a scale back in zone. We re-entered the VIX there, went up, hit second target, again, turned around, closed out all shorts on the site. Equity shorts went fully long, including shorting the VIX, gave you a very wide, fat scale back in zone. Just like the stock market, we overshot it a little bit, but we're still in close proximity. And if this market peaks, whether it falls just shy of the recent highs, all-time highs, or just makes a marginal new high and then fails, this would be your next target. And as I often state, it should be on here somewhere. I always will align. Over time, you're going to get decay in these ETFs that try to track the VIX. So that target's subject to change based on the spot VIX and the stock market. What I typically will do is when I'm getting close to where I think we're going to get a nice counter trend bounce when I'm shorting the market, then I will tend to cover my VIX either when I cover those index shorts or at times just before them. It's been my experience quite often the VIX will, not always, but quite often the VIX peaks just before the stock market bottoms. And so we'll see. But either way, just wanted to point out it's at support. This S2 was support right here. It's nice support right there. And again, I showed you what it looked like on the 60-minute chart recently, breaking out of the downtrend line right here. Nice. You take this line and that's a bullish falling wedge pattern, just like we had right here. And this is the last, well, not the last time, this previous time. Went long, rode it up there, turned around. That's when the stock market had the first drop earlier this year. Rallied back to test its 200-day moving averages, gave us a bullish falling wedge on the VIX. We get back in there, coincided with the scaling zone. We rode that one up, then we got out, and now time to be back in. All right, so that was, again, going back to these trade ideas, that was labeled another Groundhog Day for SPY, QQ, and the VIX. VIXY already covered, and then we'll just cover Riot real quick. Riot final price target hit. This was back when the market was bottoming earlier this year after everyone thought the sky was falling because of Trump's silly, 150+% tariffs on China and all this, stuff that he cowed down on, as predicted he did, and has going all the way potentially up to about 10-12 on Riot from 6 to 19 support. So that was a trade idea. And then we hit it just recently, about 60% run up there. And that is still a short trade idea. When you go to the daily chart here, there's that T3. So this is, again, just an example of divergence. Divergent low, cover shorts. And divergences at support are even all the better if you get that. And then I always say divergences are not a buy or sell signal, whether they're positive or negative divergences, meaning bullish or bearish. What's the buy signal? Even though this one, you can buy at support that's objective, and then you buy a breakout of a downtrend line. So when that happened, we hit our first target, second, third. This is resistance, a line I added. I think the potential T3 was right there. And that's it. So you can see here, little rising wedge pattern, almost a divergent high, almost an equal high, slightly higher, close enough really, but either way, that's that breakdown right there. Hit the 200s. You can see Riot's been behaving pretty well. The 200s capped it as resistance once it took it out. You can see here we had the 200s acting as support. They were broken right here, back tested. What I'm looking at here are the blue and red lines, and the blue lines is simple. And that's the one it seems to behave very well to recently. Once it took it out there, big drop, back tested it perfectly, then rejected there. Recently took it out and it's pulling out there. So you really need to see this to increase the odds or take that to a full position. I would not be aggressively shorting crypto or Riot or any of these right now until we get a little more evidence, and that would include, but not limited, include falling back below the 200-day moving averages on Riot. And this is what IBIT, the Bitcoin ETF we were using. We were shorted this one. I had given you a total of 6 targets, but when we got here, I told you that T4 was on hold, and I turned around and reversed as a long trade idea because both the charts on this and the stock market, again, for the reasons I stated at the time, expected a tradable bounce in the stock market. And then we went on to break out. So we had a bullish falling wedge, broke out, ran up, came full circle, had a nice uptrend line. There's our divergence line right there. Breakdown, and like the stock market, because Bitcoin has become much more of a risk on asset in recent years than it used to be. It came out, and the Bitcoin heads, or whatever you call them, crypto heads, said, oh, it's an alternative to the rigged system and the US dollar, which you can just print. And it used to be some of that. It would go up on its own and sometimes rally when the stock market was going down. Now it's more of a risk on assets. So where this goes will likely depend on where the stock market goes. But there are the periods where, I pointed out back then, where it did for a little while during the as the market was falling earlier this year, where it was holding up relatively well to the stock market. I pointed that out as another reason to go into it and cover that short. All right, so that's it. We just need to take out the recent lows there. And if we go up, just like the stock market, if we punch up, make a new high anytime soon, again, that's the little asterisk there. It has to be anytime soon. It will still be a divergent high. That's what it looks like on the daily chart right there. Big divergence. Okay, as I wrap up, we're just going to take a quick look at the economic calendar. Remember, you can also access this on the site. Go to resources on the top menu of the site. It's on the right-hand side. And then go to tools of the trade, and you'll get the link to the economic calendar. Tomorrow, retail sales. I'll get to that in 1 second. Industrial production. Those have the potential to move the market in either direction. Wednesday, housing starts and permits, and then a jobless claim. So that's, and of course we have the Fed meeting, but that's a non-event. Why am I calling it a non-event? I mean, depending on what the Fed says, yeah, but you can look at this, you can go to, I'll refresh it. This is the CME group. If you type in FedWatch, you'll get this. It just tells you right now there's a 99.8% chance, a virtual certainty, about as certain as it ever gets, that the Fed will do nothing, meaning the current target rate right now is 4.25 to 4.5, and that's what it's expected to be after tomorrow's meeting. So we're not gonna talk on that. Now, Powell can say some things that may move the market, probably give a little volatility in the market, but don't expect any rate cut or rate hike. That's not going to happen tomorrow. And then, as I said, so we'll look at those other things, retail sales. You can look at XRT as the retail sector ETF. That one was also a short trade idea thrown out back here. We recently hit T3 right when the market bottomed. We had positive divergence, so the retail sector rallied. Again, XRT has your Amazon, Walmart, Costco, TJ Maxx, O'Reilly. Those are your big top components there. And, nice rally off that support level as expected up on the initial tag. Plus, that's when the stock market was expected to the risk reward was just no longer favorable for shorting, more conducive and favorable to going long. And then you can see we just recently broke down. So that's the state of the retail sector. This is how the chart looks. And so we'll see. Well, again, it doesn't matter if the retail sales report beats expectations or comes in below. All that matters is this: how the stocks react. So we'll see what happens there. I also told you we have the home starts coming up. ITB is your home construction index ETF, and this one, like the REITs, not the REITs, the retail stocks. And so many other things. Remember that we're in an AI bubble. Make no mistake. You can disagree. We can agree to disagree on whether that is that or not. I know AI is real. It's a thing. But again, it's just an iteration of technology that's been around for a long time. And it's everything now is just slapping the label AI on just about everything they can. And it is a vicious cycle of spending. I will acknowledge that. The more Google and Alphabet and Microsoft spend on it, brings chip stocks up that are getting it. Again, NVIDIA is getting the lion's share of that. There's a few other ancillary companies, many of those becoming published right now too. But either way, my point is the real world, the things that really, under the hood, when you look at retail, consumer spending's over 2/3, 70% of GDP. And so I just showed you what XRT was doing, well off the highs. Here's the home builder, home construction index. So, still sucking wind. I'm going to add a trend line here. I think we've got one coming off the low right here that may come into play right here. Yeah. So, all right. So we'll watch that tomorrow or this week as well. Okay, let's just wrap it up here. This has been Randy Finney with Right Side of the Chart. Have a great day.